everybody. Hi, happy Friday. I request all the speakers of VCTV to please keep them on mute. Happy Friday, everybody. Welcome to another episode of VCTV, the Venture Capital TV. And today we're going to discuss SPAC. SPAC is obviously is in the news since year 2020. Lots of things happened in 2020 and 2021. So yes, please sit tight to hear what's happened in 2020 and 2021 and what's the future for SPAC. So yes, let's welcome our speakers today. Welcome back, Harsh. Hi, Fabio, welcome back, and Peter, hi, welcome. Long time, Peter, and welcome back.
Thank you very much. I've been traveling, but I'm back here and in my seat.
Wow, traveling, that's the news. Okay, cool. Okay, we're going to talk about which companies are great targets for merger with SPAC today. Because SPAC obviously made a lot of news in 2020 and 2021. So before we deep dive into the topic today, I'm going to take a quick round of intro from all our speakers. I'm going to start with Peter Plot. Hi, Peter, because you've joined me for after a long time, a long break. So I'd like to know your intro, please. Let's start with you.
Sure, great. So I mentioned I was traveling. It is not legal to leave the UK under the current lockdown laws, except for important transactions, and that includes for work purposes, and it must be declared. So I spent the last 12 months actually locked down, but as of the last couple of weeks, I needed to start traveling. My family office, the Weimer family office, is based in London and based in Denmark. We invest anywhere from 150 million to several billion, both debt and equity, in companies around the world. Our core business is real estate investments across any asset class, metals and mining, alternative energy, natural resources, and selected technology. We're not an angel investor. We're not a VC investor. We're looking for good companies with great management track records that could execute, and in particular through various business cycles. So that's who we are, what we do. And I'm very much looking forward to this SPAC panel because I'm in the midst of being a board member on a number of SPACs about to be launched.
Wow. And yeah, you're on the right panel, Peter, and welcome back again. Happy to see you back. Thank you. Next, I have Harsh. Hi, Harsh. How are you today? How are things back in India?
Hey, Sonu, glad to be back. Unfortunately, things in India not looking too good. We're going back in lockdown because of COVID, and COVID spreading quite crazily. So a little uncomfortable over there, but as far as work is gone, it's work as usual. Things are moving fast. A lot of new investments happening as well. And great to see Peter and Fabio after a long time as well.
Yes.
I think it's been over a month now since we connected last, right?
Yeah.
So just a short intro about myself. I'm a founder of Startup Hackers. We are an early stage startup community where we are helping startups, work with one another and grow their business collectively as a group and kind of take them to the next level. Additionally, I'm also a venture partner with our ventures. We help startups raise funds all the way to $10 million. We are completely sector agnostic, be it fintech, health tech, marketing tech, agri tech. We are open to all sectors, and any startups need any help can feel free to reach out to me on LinkedIn. And we look at Southeast Asia deals primarily, but we are open to Middle East and Europe deals as well.
Ah, interesting. Europe and Middle East as well. Thank you, and welcome back, Harsh.
Thank you.
Fabio, how are you? Long time as well.
Yep. I've been going back to normal. I'm between Italy and Switzerland now. You caught me on the road to Lugano, and I'm an economist by training. My early stage of a career included the International Monetary Fund, the European Central Bank during the launch of the euro. Then I moved to the private sector, joined Goldman Sachs in London, and then I start my adventure in the Arabian Peninsula, working for institutions, regional institutions and sovereign wealth funds in Qatar, in Dubai, and as my last stint of 8 years as Chief Strategy Officer of the Oman Investment Fund. Now, I am an investment banker. I'm a partner of a investment bank called the Golden Eagle, with headquarters in New York, offices in Dubai and Hong Kong. And among other things, we help innovative companies to raise capital on, for example, by listing on the OTC market or Nasdaq Capital. But we also try to pinpoint targets for SPACs.
Wow. Okay, so perfect, awesome. So we've got the right people on the panel today who are going to talk about SPAC, all about SPAC. So yeah, before I start, just like to introduce myself. My name is Sunny Mohanty. I'm the Regional Director of LATOKEN based here in Singapore, and I've been hosting these PPD since last year because of the pandemic. SPAC, the special purpose acquisition company market has boomed over the past several years with continued increase in IPO activity. Can you please put yourself in mute? I don't know if I'm hearing myself. with continued increases in IPO activity and record completion of these SPAC transactions. So more than 50% of total IPOs in 2020 were SPACs. This represents 4 times increase from the previous year. So let's start with the first question. What made 2020 the year of SPAC? Peter.
Oh, that's a great question. Thanks, Sonny. I think there's a couple of things to understand. You know, the SPACs are not a new asset class by any means, shape, or form. SPACs have been around for several decades. I think it became much more, call it, in vogue over the last year as some very large names looked at them as a very efficient way to take companies public, private companies public, via having a shell company. So again, been around for a long time, not a new asset class, but like the Dutch tulip bubble, okay? You need to understand what you're getting into with each SPAC. SPACs are relatively low risk for a retail investor in one instance, in the fact that you put in your cash, the cash is then invested in treasury securities. Okay, if they don't execute on an actual acquisition, then that money stays there and or is returned to the investor in a particular point in time. So in that case, it's lower risk. The risk comes about is after the company purchases or acquires a company from that shell company. And then it comes down to is, what is the company that they acquired? What are the actual fundamentals of that company? What is the prospects and what is the management team like? It's simple credit analysis, okay? But most importantly, the SPAC management team that was put together to purchase this private company also has to have significant experience in the company that it's acquiring. It just goes back to investment 101. You can't have LeBron James or Pitbull creating a SPAC and saying, let's just go out and buy music companies in the music industry if they don't have the fundamental means to analyze those companies and have the management team that's appropriate. The problem over the last year, that's why I brought up the Dutch tulip craze, is because everybody's looking at SPACs to get into SPACs. Everybody's starting a SPAC. The best way and the only way to invest in a SPAC is through hardcore fundamental analysis. That basically means who's the launching the SPAC? What is the management team? Do they have experience in SPACs? Do they have experience in taking a company public? Do they have experience in terms of managing a company and in terms of what are the fundamentals and the prospects? So again, it became in vogue because some big management names started to use it more frequently, and then everybody thought they could get involved. And that has been helped by the significant amount of liquidity, Sonny, in the markets over the past year. And on top of that, by a market that kept going up, and away. So people are jumping into an asset class just based on the fact that things are going up, and away. The reality is, if you look at in the SPAC space over the last couple months, okay, Many
Yeah.
SPACs that have been launched have not performed that well. And so the market is finally starting to differentiate the winners and the losers. And it comes down to management, management, management.
Right. So we got it very clear out there. The message is management. Thank you so much, Peter. Harsh, again, over to you, because you obviously take care of India, Southeast Asia. I'm going to come cover Asia as well, because Asia made a lot of SPAC deals as well in 2020. So what made, again, same question, 2020 the year of SPAC?
Yeah. So Peter kind of hit it on the nail, right? It is just created like a bubble. You have one or two famous people like the Virgin Galactic person, Richard Branson. He started with a SPAC. Then you had Chamath Palihapitiya coming out with a couple SPACs, and now everyone wants to do a SPAC, right? It's just like the NFT bubble which you are seeing right now. Everyone wants to jump into the NFT. Everyone wants to jump into the Bitcoin. Same is happening with SPAC. SPAC is not that simple. NFT is still a small thing. You can get it out for a few $100 and get it done with. SPAC is a much more complicated instrument, and people need to understand that. And the unfortunate reality is, right now, people might think that because of COVID, there's a sort of liquidity crunch in the market, but that's actually not true. Investors are dying to find some good investments to find money in, and that is where we are seeing this bull rush for SPAC. What is happening is investors are trying to gauge a good safe haven where they can park their money in to get in their good assets and everything,
Right.
but they are not unable to find that, and that's why the SPACs are in demand right now. But at the same time, so within 2 to 3 years, if they don't find a good company to acquire, SPACs are essentially empty shells, right? If they don't find a good company to acquire at the right valuation, it's gonna be dissolved completely. And not only for those 2 3 years, did you not make any money on that, you'll also end up losing the investment banking fee, which was initially taken just to kind of create the SPAC. So there are lots of other complications as well. And even while acquiring a company, when you want to acquire a company, the members of the SPAC, the LPs who invested in the SPAC, they need to be agreeing not just with the management team of the SPAC, but also with the management team of the company. Do they agree with the company that they want to acquire? Do they agree on the valuation which is there? It is a lot of complicated process. A lot of constant follow-ups are required. It's not that easy as it sounds. As in for the company, the founder, it may be an easy deal, but the person who's running the SPAC for him, it's an extremely complicated affair. And one more important point which normally tends to miss out on this is SPACs actually tend to be very expensive. So if you look at just to create a SPAC, it takes some 5 to 6% service fee. Then to facilitate the merger with the company, that takes 5 to 7% service fee. So overall, it goes over 10%. So in the end, by the SPACs, it is the bankers who end up making the money rather than the SPACs per se. As in, SPACs may be making the money, but bankers do end up making a lot of money as well.
Wow. Thanks for sharing that as well. Fabio, over to you, please.
Sorry, it's I feel like the eighth husband of Elizabeth Taylor. I don't have any trick left to show, because they have already said everything. So I'm left with the. But the issue is that part of the SPAC phenomenon is linked to the bubble created in many financial markets, in many areas of the financial sector, by the liquidity injected by central bank, essentially. So SPAC is one of the many manifestations of this bubble. Now, it's true that it's expensive. It's true that you need to be. It's true that you need to have a team that knows what it's doing. Often you have people who put up SPAC, have no idea what they want to do with the money. They roam around trying to find something good, and at the end, when the clock starts ticking, in order not to return the money to the investors, they fret and they start calling friends, relatives, acquaintances, ex-girlfriends, ex-boyfriends, and desperate to find a good target. Now, the reason why these
Is that true? Did I hear it correctly? Ex-boyfriend and ex-girlfriend.
Yeah.
Stop laughing.
Even those you have been abused. So it goes to like,
Right.
let's
Okay.
try the last resort, because we don't want to
Yeah,
return the money to the investors and be considered morons. But I'm joking, obviously.
I got
But
it. Got it.
there is an element of truth that when the the SPAC team gets closer to the deadline, the selection process becomes quite approximative. This being said, why the SPAC had such an appeal? It was because of regulatory issues, tax issues, and other simplification that you could take advantage of
Right.
in the listing of a company through a SPAC. Now, this is so. There is some merit in doing so, but you have to keep in mind. That the SPAC is a fund with one holding. That's what a SPAC is. So it will be liquid if the listing goes well. But we're getting to the point in which, what's the best strategy? In certain markets, and not in all markets. It's not to invest in stocks, is to go short when the tax target gets listed. And there are a lot of markets and a lot of sectors where you make much more money going short than going long.
Wow. Right. Great points there, all of you, as a opening remarks. So I just want to ask again, in continuation to this, why companies looking to go public are choosing SPAC over IPO? Why? So let's start with Peter.
Yeah, so that's easy. The So you have a company, in terms of a shell company that is already Nasdaq listed or NYSE listed. I'm just mentioning those two exchanges. Could be others, just because they're more liquid. So the company is there, and then you can bring in a private company into that SPAC. It's more efficient. It's less time consuming, and the rate from a regulatory point of view, taking a company that's private already and then putting it into an IPO requires significant amounts of audited financial statements, regulatory statements, a much longer time process than if you have a company, even though it's a shell company, that's basically now listed with not all that information required. Obviously, there's SEC requirements, don't get me wrong, and other, but it's more efficient and it's quicker because there's not a lot of stuff to dig into. Okay. Then you merge that private company into the already publicly traded on NASDAQ or NYSE company or another exchange. It's much quicker because you're just now acquiring a company with an already public company. Obviously, now that private company is part of a publicly traded company. So it goes back to my initial comments about management, and analysis. Now you have a publicly traded company that owns a private company that is now part of majority consolidated into this SPAC. It is now a publicly traded company, and that means there's all audited financials, stockholders, and people to be beholden to, and obviously significant regulatory insight. So obviously, once it's more efficient to use a SPAC structure quicker, okay, but that doesn't mean that the overall auditing that needs to take place, just
Yeah.
like any publicly traded company, will not be there and continue. So you have to weigh, particularly as a private company, do you want to be a publicly traded company, whether that's acquired by a SPAC or just by an IPO, because there's obviously significant intrusion from a publicly traded by shareholders and other stakeholders.
All right. Thank you so much, Peter. Nicely explained. Fabio, over to you.
No, I perfectly agree. It's SPAC solves, as I said before, a problem that has to do with cumbersome regulations or perceived to be cumbersome, but doesn't solve the essential element of investment. You need to check what you buy, make sure that you get involved in the management of a company whose business you know well. And obviously, in order to satisfy your clients, or let's say to fulfill their expectations, to be more precise, you end up buying a company that you don't know anything about, whose management is not top of the line, let's say. You do a bad service to yourself, to your investors, and to the company. So the appeal of SPACs in terms of simplification has translated into something, that is very worrisome, namely the careless investment
Right.
by people who have no clue where they're putting their money. Plus, as Harsh has pointed out before, all these comes at a high cost for those who put money. So you have to be extremely selective. And in those markets where SPAC have become red hot, be very careful, because there is too much money chasing too few good deals, and it's very likely that these few good deals have already gone. That's why I was joking that be more efficient and more rewarding launch hedge fund that goes short on SPACs. Again, in certain markets, in certain sectors. I don't want to make general statements, but definitely the elements of a bubble are all there. And as Peter pointed out, skepticism is sinking in, and rightfully so.
All right. Yeah, I think these are valid points highlighted by Peter and Fabio.
I did want to bring up one thing, though, Sony, which I think is very important. We did not discuss. I'm sorry about that. We did not discuss, and that is, I'm sorry, working at home, mobile's going off. The fundamental question of this panel: what companies are attractive for SPACs? And so I think that's an important one to discuss. And basically, any industry, any asset class can be part of a SPAC, whether it's a technology company, whether it's a startup, whether it's an existing technology company, whether it's an industrial company, hospitality, hotel. If anything that has taken place now over the pandemic, those companies that have been beat up, the hospitality industry, hotel, seems like they're right for a SPAC because they could provide instant liquidity. I shouldn't say instant, but once the SPAC is already publicly traded, it's merged into a SPAC. Now they have access to this hotel company or hospitality company to a publicly traded company with access to the capital markets. So there is no doubt that the SPACs can provide needed liquidity to a sector that's been beat up. But again, it still goes back to my initial comment: management, in terms of making sure that company then performs under the umbrella of a SPAC. So pretty much any industry, any company can be part of a SPAC. It goes to whether the management team has the ability to execute properly on that SPAC. And the reason we are not seeing every SPAC trade up after they've been taken public is simply because of the market finally differentiating between the good and the bad. Fundamental investing 101.
Yeah, I think that's exactly what it is. The companies which are great target for merger with SPAC. I mean, as you rightly said, every industry is fixed, but again, it's about the management after the merger happens. So Harsh, over to you with the same question. Like, why would SPAC picked up as opposed to IPO, and what are the different business risks that must not be overlooked when choosing the SPAC route?
Got it. So first, coming back to the original question, why would founders be interested in SPAC, right? So for them, it's obviously a far more easier thing, as Peter and Pavel pointed out, right? The kind of legal regulations, financial regulations, the FCC guidelines, and all other guidelines which are required through an IPO listing is extremely complicated. Additionally, what the biggest factor which is involved over here is the risk factor which is involved, right? On the day of the IPO launch, if the IPO does not do well, it could lead to a huge collapse for the company. Look at what happened with WeWork a couple of years back. Even Uber did not do that well in the IPO. There was one more company earlier this year which launched, did not do that well with the IPO, right? So IPO has an inherent element of risk associated with it, and you never know how it's going to work. So after 6 to 8 months of hard work, if the IPO is completely bombed, so everyone that is involved in the ecosystem, be it the bankers, the company, the investors, everyone kind tend to lose a lot of money. SPAC kind of provides them that kind of a security. And that is where, SPACs really became attractive for everyone, and everyone wanted to go through the SPAC route. Essentially, that is why the demand for the SPAC has been. So that was the first part of the question. Now the second leg of the question, which kind of company would be suitable? So obviously, any company can be, merged and acquired and absorbed into a SPAC. What my understanding was, the original demand for SPACs from retail investors came from was, due to the COVID era, people thought that you could easily acquire companies at a significantly lesser price than you would do in a pre-COVID era, right? Because the multiples which you were traditionally getting, they were quite lower now. So even when you go for fundraising, the valuations are lesser. If you want to buy and sell companies, the valuations are lesser. So SPAC would have made it far more easier to completely just acquire new companies at a significant discount price. That is where I thought was the original focus for SPAC, and why retail investors were interested in that. So now, if you look at that and we combine that with the current situation, where which kind of companies which can look at. So definitely manufacturing and service sectors, they can definitely be a good target for that. But I additionally see a good opportunity for tech companies as well, right? Because a SPAC is essentially a VC fund for general investors. A VC or a private equity fund, essentially they have money from a whole slew of investors, and there's a managing team who decides whether the investment happens or not, right? However, a VC fund is restricted that the investors are typically accredited investors who have like a certain minimum amount of money to invest on a yearly basis. Same is not true for SPACs. SPACs can do retail. SPACs have retail investors, right? So that is essentially the difference maker which I see over here, and that is why a lot of these tech companies per se, they could be a huge attractive target for them to look at SPACs, because if these tech companies, they tend to go IPO, it may or may not work for them that well. But a SPAC can kind of ensure that it's going reasonably well, and they get reasonably safe returns out of a SPAC.
Yeah, I think nicely explained there, Harsh. Who are the target industries for SPAC? I think very nicely explained. Fabio, would you like to add something about risks? I mean, obviously, we know the target industries. Every industry can do a SPAC, as Peter rightly said, and Harsh also brought up, like manufacturing and tech. But what are the risks they need to know associated with? I mean, obviously, I'm not going to IPO, I'm going SPAC. But what are the risks they should be aware of?
I would ask myself, I mean, if you invest in a SPAC where the target is pretty much clear, then the risk is the risk of emanating from the target. If you don't know what the target will be, you can't even start to evaluate the risk, because you are in complete darkness. So you don't know if you end up owning, I don't know, a bus company, a franchise for pizza, or a cybersecurity company. So that's something.
Fabio, you bring up a great point. one of the beauties of SPACs and also one of the risks of SPACs is they purposely make them sufficiently vague. What does that basically mean? They don't basically say we are launching a SPAC to invest in a hardware technology company or software technology company, or be so specific as an AI company in the medical field. No. We're going to invest in AI. We're going to invest in a SPAC for hospitality and technology surrounding hospitality. That means they can invest in hotels, they can invest in entertainment, they can invest in yachts, they can invest in a retail franchise for food, because that's part of hospitality. They can invest in a bar, they can invest in a new technology startup. So they're sufficiently vague in terms of what they're investing in to allow them a broad bench to find a particular company or companies to acquire into the SPAC. And that's also where investors need to be cautious.
Yeah. By the way, even if they limit themselves to hospitality, just to give an example, can be hospitality in Los Angeles, New York, Miami, Italy, Syria, Somalia. If they don't specify at least the geographical outreach, you have no idea where you're putting your money. So essentially, you trust the SPAC promoters, and then you pray at night that your choice has not been too risky. That's what it is. Now,
but the offset of that, Fabio, there is an offset, and that is by putting your money into a SPAC. The SPAC initially is invested in treasury bonds or bills or whatever. So the cash is there. You know exactly what the SPAC is from day one. It's up to the management team over the next 12 or 18 months to use that money to acquire something in line with their objectives. So it's really your trust in the management team that is key more than anything else, because if they fail to identify, a good management team will say there's no opportunities, they fail to invest, the money is returned to the investor. So they are liquid, they are safe in the means that if they don't find a relevant company to invest in, the money is returned to the investor. Have
you ever seen something like that? That's money, Peter. I'm not. I don't have a multi-year experience, but I have never seen money returned to the investors.
Oh.
Have you ever seen, experience something like that?
There has been. If you look in history, if again, this goes back for decades. If they properly identified company hasn't been found, the money's returned. But it goes back to. That's why if I was going to invest as a SPAC in a retail, I want to know which is the management team that is going to invest, what the target company is, and also that they've hired an investment bank that has experience in creating SPACs and distribution of SPACs, not some investment bank that you've never heard of before that all of a sudden says they're a leading provider of SPACs. You need to go to the ones. And that doesn't mean it has to be Goldman Sachs or something. It's just it could be a small, mid-sized investment bank that has that experience in SPACs. And also, who are the auditors? Who are the who's underwriting it? All those things come into play. You got to do your homework, just like any other investment.
Absolutely. But Peter, at some point, one needs to ascertain why the SPAC's target prefers to be acquired by the SPAC and not go through an IPO. Because what is an IPO? What is the process through which you get listed? It's a process of information providing, information validation, and information vetting by the market. Now, if a company prefers to do this, to perform this process with a team not in the open, It might be because they don't want to be bothered. They don't want to undergo all the trouble that is related to an IPO. It might be because they don't want to be scrutinized.
Right.
And so one has to be very clear what is the quality of information that is available on the target. And if you trust the team, you trust that they will perform their duty in terms of due diligence and other information processing. If the team is not up to the job, I'm not sure what might come out of it. So again, it's the bubble is clearly getting out of hand, and those who feel the need to ride the wave need to do a lot of homeworks, maybe much more intense than the homework you do in a normal IPO.
Right.
So,
Is it
Fabio, actually, Fabio made a very interesting point at the end over there, right? It could be a reason where companies, because they simply want to avoid the due diligence which is entailed in an IPO, and they're simply looking at a SPAC as an easy outlet. So that is a major risk factor for a lot of retail investors, right? Additionally, another major risk factor which I would like to point out is, say a private equity fund or a VC fund is starting out their own SPAC, right? In that case, don't you see a clear conflict of interest? A private equity or a VC fund has their own SPAC, they'll try to push their own companies into, they'll get the SPAC to acquire their own companies, where not only they get the initial fund, the fund management fee, the 2% fund management fees, additionally they'll get the investment banking fees for operating the SPAC. So that's a clear conflict of interest over there as well. So there's just too many issues and too many complications surrounding the entire thing. And that is where even the private, the individual family offices like Peter's operating, and a lot of other retail investors and the sovereign debt funds, they're getting into this conflict as well, because there's a clear conflict over there. They'll simply kind of push their own company to kind of provide an exit to the fund and get absorbed into the SPAC, and get the money by doing the double commission for themselves.
Wow. Oh, okay. Ash, that's like a eye opener. But anyways, thanks for bringing that up. I just want to know who is involved in a SPAC deal right now, if at all. I would like to know what are the factors involved in the SPAC life cycle.
But I'm involved in the sense that they've asked me to look for targets.
Right.
And that's why I'm saying it's not the first time. And when people are fretting, I don't like to get involved, because having people going around like headless chicken, it's not the right approach in my view. I'm a bit conservative. I like to go through due diligence, due process, and think about the various stages of the process. But essentially, they've asked if I have knowledge of good targets. That's what I'm looking for.
Right.
But even, you see, sometimes when you get these requests and you try to get more specific information, the answer is, oh, well, anything. Just a good company, or sometimes you have they ask, well, a company which is undergoing generational transition, or a company where we can act as a turnaround fund. So there are sometimes requests that make more sense, or delimit more clearly the perimeter of the request. When you get a company, look, in 3 months we need to complete the operation, otherwise we must return the money. That's something you want to stay away from.
Right. Wow. But how come there were so many SPAC deals in last year? I mean, again, I want to know, explain what's the SPAC life cycle looks like. So to our audience and for other speakers. So Peter.
I could start with that. Yeah. So the SPAC lifestyle is not that much different than an IPO. But like I said, it's usually more efficient and less time consuming. First and foremost is assembling a proper board of directors and appropriate leadership team or management team of the SPAC I'm talking about right now.
Right.
After that's been done, is putting together a presentation deck for investors in terms of what is the actual strategy, what is the target industry and specifically companies, and what does that leadership team and management board bring to the table that should be attractive to investors. After that, it's going through the proper regulatory paperwork to list that SPAC on one of the major exchanges. This is not something that could just be done overnight. It's a several month process or longer. But once all those I's have been dotted and the T's have been crossed, then it's a pretty much just checking boxes. But as Fabio mentioned, once that SPAC management team, leadership team, and appropriate investment bank and all that has been set up and it's launched, now is really the real challenge, and that is the execution. Fabio says he's tasked with finding target companies. That's no easy task, because you need to find target companies that are not just a company to merge into a SPAC, but a company that you feel that the management team and board can enhance value that wasn't enhanced as a private company, meaning as a publicly traded company, okay, this management and leadership team can do a better job than the existing management team of the private company without the broad-based public perception, rectal exam, you might call it. Every quarter, financials are being sent out without that public scrutiny. Can this management team perform the operations of this company better as a publicly traded company than if it was left alone as a private company? And that only the investors can judge by the quality of that management and leadership team that's put together. Now, if you bring in, some of the higher profile ones was, Bill Ackman and Pershing Square. I mean, here's an extremely knowledgeable, successful activist investor who takes companies, finds that they're undervalued, and through activist management has been able to extract significant value and find undervalued companies. Now, there's a lot of confidence there that he would be able to do the same in turning around companies that he's identified, his team has identified, to benefit from a publicly traded forum and in the SPAC structure. So like I said, there's no magic formula here. It is the hardest task is identifying those companies. If you don't identify the proper companies and you purchase them, the SPAC value will trade down and investors will lose money. But that's, so it's again, fundamental analysis, finance 101.
So
that's the process.
Yeah. So yeah, that's the process. So that's the finding the target companies to invest in money is the hard task, because as you rightly said, once get listed.
Besides, the increase in value that you bring has to cover the cost of setting up the SPAC, first of all, just to end up even. And then to actually make money for your investor as a SPAC promoter, you need to be quite sure that you improve the performance of the target not by 10%, because that's the cost of the SPAC. You have to be able to bring at least a 30% improvement in the performance, in the bottom line, in order to make the deal worthwhile.
Right. Okay. What are some of the de-SPAC transaction considerations to take into account?
Management team. I mean, if somebody, and the specificity of the proposal. So if I have an artificial intelligence guru that says I have a team of people I've worked with for 5 years, these are top-notch professional. Give us 100 million because we want to go out there, and we know already this sector. We know already the best company in the sector with 100 million in the coffer. We go out there and we try to convince the best one, or at least one of the best one, to go public through a SPAC.
Yeah.
That's something that sounds reasonable. Otherwise, I would be very cautious.
Right. Harsh?
Yeah. So as Fabio and Peter pointed out, right, it has to be a clear-cut plan where I have a specific company in mind. This is the area which I'm looking at. Very razor sharp focus is required. It cannot be like, I want to invest in AI, or I want to invest in hospitality, or I want to invest in supply chain. If it is that broad, it can literally be anything under the roof, right? And what is that unique value proposition which the management team is bringing? You don't know that. So that's why it has to be very specific, very razor sharp, specific plan in place. All that nitty-gritties are required. Only then can a retail investor can get a true sense of confidence that yes, this pack will work out, right? For example, if you go into the logistics space, there are multiple avenues in the logistics space, right? The B2B side, the B2C side, country specific, state specific. If someone is saying, getting a SPAC in, say, California, which is one of the most expensive areas to live at, and then they end up buying somewhere in Philadelphia or maybe in, say, Mexico. So it doesn't kind of justify, right? So that is why it has to be, the details of the terms have to be very specific, that this is where you're going to be investing in. And, the management team has to prove that they've done that thing very well in the past. That proof of validation is required. Without that proof of execution capability, and not just a big brand name, but a big execution capability as well. And they need to be able to hire. So obviously there have to be, some people who are kind of the face of the SPAC, and there is a leadership team who are going to be focusing on the execution of the SPAC. So you need to have a good balance of everyone involved.
Right. Perfect. Thank you so much for sharing and making this session very useful in terms of understanding, because SPAC is obviously very new for many people and our viewers as well. So thanks for taking us through every session. I'm actually learning more better than my previous sessions. Thank you so much, Fabio, Peter, and Harsh.
Pleasure.
Sorry, Peter, did you say something?
No, thank you very much. It's been a pleasure.
I'd like to take some closing remarks. It's a Friday, and so before the weekend, I just want to wrap up and don't want to get you stuck here. Maybe not stuck. I hope you enjoy VCTV. Peter, you've been around on VCTV for quite some time already. I remember last year hosting you as well for the Asia episode.
No,
I'm a family member, and so is Harsh. So let's take some closing remarks about the companies who are there, because in Asia, in Southeast Asia, one of the SPAC deal was Grab, the deal that happened recently, the ride-hailing company. So there are other companies as well who are private and want to go public but do not want to do an IPO, but they're still probably figuring out a SPAC. So let's close the session on a closing remark. And what do you advise for those companies who are looking for a SPAC as opposed to an IPO? Peter?
So my closing remarks are quite simple. A SPAC is a means to have a company access the public capital markets in a very efficient format in a timely fashion.
Right.
However, the process, the asset class has been around for decades. It's nothing new. It's been brought more infamous over the last year by some very well-known asset managers starting to use the SPAC as many of the tools in their tool case. The SPAC process, the SPAC management, and the initial transition from private company to public company has its challenges for the management of a private company that has operated without the umbrella of foresight and insight from various stakeholders, including shareholders, as well as the public scrutiny that a regulatory regime imposes from being a publicly traded company. So the management of a privately traded company on that end needs to understand whether they really want to be a publicly traded company with broader access to the capital markets, or they're perfectly comfortable remaining a private company and out of the limelight. So that's question one for the actual private company thinking about being acquired by a SPAC. An investor, whether retail or institution, into a SPAC needs to do their fundamental analysis, just in like any investment decision, in terms of the management team and board of directors of any particular SPAC company, their ability to execute the SPAC, and their ability to then identify within 12, 18 months, 24 months, usually max, an appropriate target company that they feel, the investor I'm talking about, feels that management table will be able to execute the operational strategy and possibly future acquisition strategies better than the current management in their privately traded form. From a retail investment point of view, investing in a SPAC is actually, if you believe in the management team, if you're confident in what they're going to execute on, you do have the benefit that the day you put the money into the SPAC, you know what that is worth, because it's simply the amount of capital that's been raised is put into liquid treasury securities, etc., until a company is identified. So you know that if a company is not identified, your return of capital is likely to occur. So those are just some closing thoughts. I think it is, the fact is, again, it is a very efficient, it's a very time sensitive means for companies that are private now to tap the capital markets in an environment that is so flush with liquidity globally. It is a very efficient means to attract that global liquidity and potentially help management of a private company have access to capital that they otherwise wouldn't be. But it doesn't change the need for research, just like any investment.
Just like any investment. Very rightly said. Thank you so much. I mean, we have investors, we have startups as well. Obviously, they need to figure out if they want to go public, as Peter rightly said as well. So, hi, Fabio, over to you with your closing remarks, please.
Yeah, my closing remark wants to stress one element which we haven't brought to the fore so far. It's different if you, as a SPAC team, inject capital, so put, say, 100 million of new capital in the target, and you use that 100 million to finance an expansion plan. So an ambitious business plan, multi-year expansion in new markets or in new business lines. A different matter is if you buy from the existing shareholders their stocks. So it's the nature of the operation is substantially different, and that needs to be, in my view, declared ex ante by the SPAC team. So if you want to just buy shares from existing shareholders, or if you want to finance the expansion of the target, because again, these are quite different endeavor, and the risks are eminently in a different category and in a different magnitude. So, bottom line, be careful, ask questions, don't be shy, and if you don't want to regret
Yeah.
where you put your money, make sure that you know the people in whose hands you give the check.
Yeah, the target companies, the management, and yes, everything. Thank you so much.
Everything. Ask question, ask twice, ask 3 times, get the confirmation in writing, possibly signed with blood, because that's important. Discipline and information; those are the pillars of the financial sector, the healthy financial sector. Everything that goes beyond that, it's speculation, hazard, and worse. Could be fraud and deception.
Wow. Yeah, sure. Thank you so much, Fabio. Thank you so much for those closing remarks. Harsh, over to you with your closing remarks, please.
Thanks, Tony. I kind of feel like Fabio now, that Peter and Fabio have kind of covered most of the topic. There's nothing left much for me to say anymore.
Yeah.
So just one final thing I would like to say for founders is that essentially, the fact in the year 2020 has been highlighted as the golden bullet, right? It's kind of like a solution of all your problems. You want to go public, here you have an easy solution. You can go public, that easily. You don't have to worry about the IPO and all that, like, which is involved. But that's actually not the case. So always take it with a pinch of salt. Always understand the details of the terms. Read the fine print, read the finer print, read the finest print, read everything, read the terms that are involved. Because even for the founders, it's not that easy to get acquired by a SPAC, right? Because it's gonna go a long way to and fro, and sometimes the deals might involve a 3, 4 year, 5 year retainer within the company to kind of provide like a smooth exit. And a lot of other those terms which are involved over there, right? So even the founders need to be extremely careful and be thorough that this is actually the route that they want, or rather they simply prefer keeping the company private for the long haul rather than trying to take it public. So a lot of those kind of decisions are involved, and hope the startups do take it carefully, and as always, do your due diligence on the deal as well.
Perfect. So yes, I think everybody sort of gave the same sort of closing remarks, closing thoughts. Just be cautious and careful, right? We don't want to lose money. Nobody wants to. So yeah, thank you so much again, Peter, Fabio, Harsh. Thank you so much for taking time out to be on BCTV on a Friday. So as I said, this is the weekend episode, and I hope that all of you have a great weekend. And for the viewers who just watching BCTV every day and sending us the love and comments, thank you so much for being us every day. I'm going to be back again not tomorrow, next week on another episode of BCTV. Till then, keep watching BCTV. Stay safe, stay healthy, stay happy, and I'll catch you again on another episode.
Thanks, guys.
Bye.
Bye bye everyone.